In a market, in a futures market, that, by the way, we should point out is pricing in no rate hikes next year.
No,
Maybe
zero
coming into this, but the Fed says too. Hal, let's get your take. I know you weren't really among those rooting, right, for the Fed to hike rates at all, but they do so as expected. But your interpretation of that, and is there enough in this statement for you?
No, absolutely not. It's a big mistake. I think the Fed rate hike today was a mistake, and the language is really disappointing. I mean, they really should have moved to a data-dependent language. To say that they're going to do 2 rate hikes next year is not enough. This market's going to sell off. It's going to sell off into the close. It's not going to stop selling off until we get to the close, in my opinion.
Yeah,
I think, look, you've got oil prices collapsing. You've got commodity prices down across the board. There is no inflation. There is no reason to do what they're doing. We've got inflation at PCE deflator is where it's right where they want it at 2%. It's been that way for years now. It's basically been unchanged since 2012. And like she said just now, the balance sheet is being unwound, which has never happened in the history of the country. So we're looking at a December here. The market's down as much greater than it has been since 1931 in December. You know what was in 1931? The Dust Bowl. Okay, so we're looking at unprecedented decline in the stock market, and we're not coming off 25 PE multiples. You know, we're looking at interest rates that have gone from 3.2% on the 10-year to 2.8. The market is telling the Fed we are slowing dramatically and to stop raising rates.
All right, Kimberly, your take.
Yeah, I mean, I think the Feds were in a rock and a hard place, right? So they sort of had to raise rates to be able to remain independent, and I think that's what's going on. Part of it's going on here to save face, and so they had to raise rates. You know, the Fed needs to practice, you know, the 3 Fs, basically fair, firmness, and flexibility going into 2019. And we have been addicted to this liquidity addiction, right? And I think the Feds have to maintain this like 12-step process to get us off this addiction and get us back into a healthy economy. So going in and saying two times in 2019, the surprise for me was one more time in 2020. I'm not sure if that's going to happen. That's my opinion. Our investors are invested 100% across the boards in 44 different countries in basically over 12,000 different stocks. So we don't worry about timing this, but have some dry powder on the sidelines so when these dips come in, you can practice the 3 Ds, discipline and diversification. Go ahead.
There you go. How many Ds was that? No, the market right now is interesting. I want to bring Jonas Ferris, who's also here in the studio with us, to kind of join the panel. But the market has been gyrating a bit, which is kind of par, right, for the course, Jonas, after we get a decision like this. I know, everybody has their views, and as Hal is probably the most aggressive in saying this is a kind of a mistake in the way things are worded in the statement. It's not far off, though. It doesn't take much, by the way, for a market to move, but not far off, certainly, expectations. We expected the quarter-point rate hike. We got it. A lot of people were looking for them to go to 2 rate hikes next year instead of 3. That's what we got. What stands out to you, if anything, from this?
I think the market, the expectation was raising rates, but the expectation was coming down in recent weeks, particularly. There was a really good article in the Wall Street Journal. I've been talking about this for a while. They don't need to raise rates anymore. They're creating a scary situation where short-term rates are going to be higher than long-term rates. And that makes people think there's going to be a recession. Whether that always is going to cause a recession or not, it doesn't matter. People were scared about it. We just saw almost $50 billion come out of stock funds in like a week. That hasn't happened in a very long time. People are scared there's a recession. They can psych themselves up into a recession. There's not, just because unemployment is at like 50-year lows doesn't always mean, from some economics textbook, that you're going to have runaway inflation. Right. The Federal Reserve has more power to control inflation now than ever before because they created so much fake money in the last crash. They could always start unwinding that faster than they are currently naturally letting it run off. It's a complex issue I'll get into later in the show, but it doesn't matter if inflation gets ahead of them because they can make it go away, and they're going to ruin what's finally a strong economy. And only strong here, really. It's now not strong in many other countries. China is having a lot of problems. Germany.
Right, which they talked about. They talked about the global slowdown.
If they're going to do one and be done, I think that Wall Street will get comfortable with that. But if they just keep doing quarter points, it's going to be problems. It's going to be serious problems.
It looks like, though, that they will slow down a little bit next year. I guess the point is that everybody's making here is that they could have been more explicit in saying that, hey, we're done for now. And we did not get that today. We didn't get that.
Absolutely. And to the point of quantitative tightening, the shrinking of the balance sheet, there's built-in tightening. For every $50 billion of shrinkage of the Fed's balance sheet, and this is actually what the president tweeted about yesterday, every 4 months we get the equivalent of another rate hike flowing into this economy, slowing the economy. And people have to be cognizant that the whispers on the street and on the trading desks going into this was that they were going to cut quantitative tightening in half, cut it from 50 billion to 25 billion. I think that markets were hoping for a Christmas surprise from the Fed. They certainly didn't get it.
Yeah, didn't get it, right, Christina?
No, and I think in the Fed's defense, the fact that they use the word some is just allowing them some leeway. And they can't show that they're reacting to equity markets, though. They're supposed to be independent. Right. Markets are supposed to not represent the economy, despite what the president...
They might have thought they would freak out. I mean, I know they can't show. Hal, what are you going to say?
Yeah, I mean, I agree they can't react to equity markets, but there's so much more they can react to, which is there's not inflation. And I think they're worried about being considered bullied by President Trump, and they shouldn't be. That shouldn't be taken into consideration at all.
Yeah, I was going to bring that up. I mean, I was definitely going to bring that up. Well, you brought it up now. We may as well talk because it is interesting. I know a lot of people have divergent views on this about, and I don't know what yours is, Jonas, about how the president's tweets and the pressure. He's clearly trying to influence the Federal Reserve. I mean, he says as much. He's very open about it, but I don't know how that affects their thinking, or if they would have raised rates today or not without it. I really don't know.
First of all, the president was probably right about interest rates. It seemed like they were going up too fast and it was causing a drag. Now, the president's also trying to hedge against a recession, and he can blame somebody.
Right, looking for somebody to blame.
But the Federal Reserve was living in a 1970s world where, like, the normal rate is like 5%, and we're going to have double-digit inflation if you let it get out of control. And that world doesn't jive with Donald Trump's real estate development world, which is probably more accurately represents the world's economy now that is highly leveraged, full of commercial real estate that only just came back because of low rates from the last crash. Is it unorthodox? Sure. Was he having secret meetings with them like Nixon was? It wasn't that bad. It was just tweets, basically.
Right, it was out in the open. We all knew
so it wasn't secret. It was
you could argue whether that's appropriate or not, but it was. We knew what he thought. It wasn't some behind closed doors. But you're nodding along.
Fairness,
1 second, Hal. So Danielle was nodding along, and we're right back to Hal on this.
Yeah, optically, and this question is going to come up first and foremost in the press conference at 2:30. Somebody's going to ask this question, but every single time that Powell has been asked about President Trump and the seething criticism that is absolutely nonstop, he just waltzes his way around it. He's extremely diplomatic about it. I would expect nothing less today in the press conference.
What are you going to say, Hal? And then I know you're there, Kimberly, but I'll get back to you. But what are you going to say, Hal?
Well, first of all, President Trump has been right. Let's start with that. But number two, he's not the only president that's ever done this. I mean, President H.W. Bush complained about the Fed. He just did it after the fact. I mean, Alan Greenspan threw us into a recession, raising interest rates too much. The Fed's been wrong a lot. So I don't think criticizing the Fed is a problem, but I don't think the Fed should then go, we've been criticized, so therefore we have to go the other direction.
So do you think
just to make sure people...
Your point is you think they did that? They wouldn't have raised rates today at all, even, is your point, Hal? Is that what you're saying?
Well, I don't know necessarily they wouldn't have done that, but they certainly, I think, would have softened a whole lot more for next year.
Right.
And they certainly haven't softened enough, and I don't think the markets are going to like it.
Right. And by the way, the Dow just turned lower, and it's bouncing back. It's up a little bit now, but it's going up and down. It was up to 275 to 300, somewhere in that range in the minutes before. Kimberly, do you have a take on this about the influence, if any, from the White House and the thinking today, not only on the fact, as Hal says, that whether rates would have went up, but whether we would have had a softer statement if it wasn't for the president's pressure?
Yeah, I think there might have been a softer statement, but I think that's the problem. The problem is the Feds need to stay independent, and I think that was, subconsciously why part of the reason they raised rates, because they had already said it. They set that expectation, so they really need to follow through to kind of save face and remain independent. And I think the Feds need to be able to just adhere to their dual mandate 2019 and really become data dependent again. And set the slate clean for 2019 and move forward. And ignore the political pressures, because that's what they need to do. That's what their mandate is.
So Edward Lawrence, who gave us the number at the top, will be among the reporters at the bottom of the hour in this news conference that Danielle talked about. So, well, Christina, you're the reporter in the bunch. No offense to Jonas. I mean, he's an analyst. And so what type of question? I mean, some of them are obvious, right? But I wonder what direction the media will take Jay Powell here at the bottom of the hour. I'm sure you're right, Danielle. The president's obviously going to come up. So we'll see.
Come up, but I think what the term some means. Like, can you allude to just two hikes going forward, and then 2020. I think that what are the factors too? Are you looking at the labor market tightening?
Right.
Excuse me. And you have the oil being a major factor too. So how is that signifying an increase in inflation when you have oil falling below $50 US a barrel? So I think those are some of the things I would have looked at. What economic data is worrying you at the moment, given this strong economy, for you to go ahead and continue with this these hikes? And then liquidity. I think that's a major factor too. Liquidity in the market is scary right now.
We are seeing some real gyrations in the bond market right now that should have Powell's full attention. He understands the financial markets like none of his predecessors since Paul Volcker. But to your point, you know, the thing is, they did say that the unemployment rate was going to continue to decline to 3.5%. That means that they're signifying that they see the economy as continuing to accelerate, and they continue to be worried about inflation that is clearly, obviously, because of oil prices coming down and pressures from outside of our country. Inflation is not a problem.
Well,
Yeah,
to be fair, okay, there's a lot of reasons they shouldn't raise rates. And Christina, you brought up about the assets before. There's no real inflation, but there is asset inflation. And they're not really supposed to watch that well, but that is what they're watching, because that's what they cause more when they lower rates in this kind of an economy where you can price check across the internet. They boosted asset prices. And a few months ago, tech stocks, we were on the edge of another bubble. Possibly real estate, definitely corporate debt,
for a
too
lot
much
of them,
borrowing. They need to get ahead of that and pinch that, and they did that. I mean, there's no question, like that little bubble thing ended
within the tech, but look at corporate debt levels.
Now the problem is, are they going to cause a recession by trying to nip a asset bubble before it even got way out of control in the bud? And I would add, that's what I would get into. Was this really just a prick? A lending boom bubble, a tech bubble? Was the economy about to get too hot in the investing world? Not so much in wages, in employment, in prices of eggs in the store and cars. Was lending getting too reckless? Was that really what they were targeting with this? And the only other thing you could say that made sense about what they're doing is they have to show that we're not in a recession fighting mode when the next recession comes. You don't want investors to be like, wow, we already cut taxes, we're at 1.5% Fed funds rate, and now we're in a recession. How are we going to get out of this? You want to be like, oh, don't worry, we got tools. Remember, we just raised rates, we can lower rates. So that has a psychological benefit to make us think we've got a plan for the next recession.
All right, let's get a little market reaction here. We'll come back to this discussion, and we'll get set for the Jay Powell news conference, which is coming up at the bottom of the hour. Now, in the bond market, the yield on the 2-year went up a little bit. The 10-year yield a little bit lower following the rate decision. In the stock market, that's where we want to bring Jerry Willis in. She's on the floor of the New York Stock Exchange with the reaction from there. Hey, Jerry.
Hey, Connell, what a reaction in the marketplace. We were up 374 points right before the announcement, and then plunging as much as 164, now up 31 points. Big move in the market, and let me tell you, Danielle had it right. It's this idea of quantitative tightening that the traders are so concerned with down here. Very worried about that, continuing at 50 billion rate a month. They say that's what we're doing right now, and it's creating major problems, major headwinds for the economy, decreasing the liquidity. They don't like that, not one little bit. And as one trader told me about the idea of just the right now rate cut, which is what we expected. Everybody expected a quarter-point rate cut. That's what we got. One of them said to me, Jerry, there is no dovish rate hike, right? No dovish rate hike. So you can't tell me that the Fed is making a turn to being dovish when they're increasing rates. So lots of concern down here about this. And as you can see, it's playing out in the market. We're back and forth. The machine's kind of in charge right now as we kind of probably will stumble a little bit into the close. Connell, back to you.
We'll see what Jay Powell has to say for himself here in a few minutes as well. Jerry, thanks. We'll go back here to the panel, and we're joined up. Just reintroduce everybody very quickly so you know who you're dealing with, or I know who I'm dealing with. Danielle DiMartino Booth, Christina Partsinevelos, Jonas Ferris, all here in the studio. Hal Lambert and Kimberly Foss with us as well. All right, Kimberly, let me go to you. So Jerry's talking about the stock market, and we definitely saw some selling. So equity investors certainly weren't pleased, I guess is the term, with the fact that to use her term, she's right. We didn't get this dovish rate hike that a lot of people had expected, and we saw a narrowing of the spread between kind of short and longer term bond yields as well in the government treasury market. So what do you make of the market reaction, Kimberly?
Yeah, I mean, I think that the sell-off is probably very, very conducive of what the Fed's said. However, I think long term, this will it'll normal itself out. I mean, investors really need to make sure that they are invested in the market for the long term, and whatever their exposure to equity is commensurate with their ability to stay in the market through these volatilities. In the meantime, we're shortening up the maturities.
Okay.
We're at the 3-year mark for the yield curve, and I just think that investors again should practice that 3D investing, like I said, diversification and discipline and dollar cost averaging as these markets go into negative territory to buy on the discount.
Yeah, you look for some bargains in here. By the way, the Dow's up now by about 100 points, so back and forth we go. How do you play this? I know you're not happy with what the Federal Reserve is. We get that, what the Federal Reserve is doing with the course of action. What about the investment kind of angle here and strategy from your point of view?
Well, I don't think markets are expensive, so I do think it's way overdone as far as the sell-off that we've had, and it's been driven, as many people have said, by a lot of the machines out there trading and not individuals making these decisions. But one thing I want to say is I think the Fed models need to be looked at. They seem to think that at 3% GDP growth, that's inflationary, and they've got to stifle that growth back down towards 2%. That seems to be the underlying assumption. That is just not correct. We need 3% GDP growth for a lot of reasons. But again, as someone said earlier, this is not the 1970s. We have real-time data. These companies have real-time information on inventories, cost of goods sold, sales. They can make adjustments quickly. We're not going to look at, they don't have to wait until quarter end to get their CFO report and go, oh my gosh, we didn't meet the sales goal that we thought we were going to have, and then start making adjustments. This is all done real time, and it's not really been that way. It's been that way basically for the past 10 years. But prior to 10 years ago, this type of real-time data wasn't there. I think inflation can be controlled because of productivity,
right,
and it gives us the ability to grow a lot faster than we're growing.
You agree with that, Danielle, that the Fed's kind of dealing in an old world, that they're essentially just not up to date with the data that they're using, and there are better ways to look at this? The model's broken?
Yeah, as a former Fed insider, I would say that definitely the model is absolutely broken. It is the most antiquated methodology. And in fact, we've read the transcripts from 2012. They're a matter of public record. Jay Powell himself has called into question the models. Yeah. So I'm surprised at how much they're adhering to them, even though we have 48% of CFOs in the country saying that they think the economy is going to be in recession. He's clearly not speaking to the CEO of FedEx that came out this morning and said the global developments are affecting our top line. 40% of Standard & Poor's 500 revenues come from overseas. So, I mean, I'm not sure how much more proof Jay Powell needs, but he's about to get it when earnings season starts.
Yeah, and got it really in the commentary, to your point, in the last earnings season. And FedEx was more of the same last night. That was a kind of a startling number in some ways from FedEx. Maybe it shouldn't be, but it's a big company, and it said, hey, things are slowing down everywhere.
Well, we've seen that 20 out of the 30 Dow companies that released their Q3 earnings, they reported currency headwinds as a major factor going forward. So the strong U.S. dollar may be good for people traveling, but you have the fact that tightening in the market, and then the strong dollar makes it harder to sell products abroad. That's affecting the price of oil. Hal, you just talked about the market maybe being too cheap, but if you look at some of those factors and the warning signs coming from companies, and you also have big auto companies in the United States laying off employees. Why is that happening? You have you have the yield curve bond market. Usually, I know the short end was inverted, but the gap between the 10 and the 2 is narrowing and flattening. So aren't those signs of concerns for you when you're talking about markets going forward and the strength in the bull market?
Oh, those are big concerns. I don't disagree with that at all. Those early cyclicals have had that problem for a while. I mean, housing slowed in February of this year. Autos slowed earlier this year as well. So those signs have been there. But with low unemployment, we should be able to continue to grow the economy with the consumer. The consumer is the biggest driver of the economy, as we know, in this country. Overseas is a concern. But if you look at the P multiples are not that high. If we can stop the liquidity drain by the Fed and the Fed interest rate hikes, I think the economy can keep growing at this 2.5% to 3% level. And if that happens, then earnings should be okay for the economy. Now, individual stocks are going to have problems. FedEx announced it, but again, that's a driver.
What about consumer debt? You're saying growth by the consumer, but if I go to the store and I can't afford anything, but I'm putting everything on my credit cards, sure, I'm fueling the economy, but then later I'll default and have absolutely no money and go personally bankrupt.
That's exactly right.
Well, I'm not rooting for that,
No,
we've already seen automobile delinquencies tick up to the highest level since 2011. There's something happening in the household sector that the data is starting to communicate that they're not all there.
What do you think, Jonas?
Look, it's easy. We're all money. Like it's easy to tell the Fed what to do, and I do think they've made mistakes and they're living in the 70s. But I will say it's a very leveraged global economy. And
Other than that,
the last two major recessions were basically because they let asset bubbles build in the economy, and then they collapsed, and it caused serious problems. And unfortunately, Federal Reserve policy, because, and the Federal Reserve guys, whenever they leave, and women now, whenever they leave, they always say the federal government should be doing more fiscally so we don't have to do all this heavy lifting with the stupid interest rates. Anyway, it's all your own fault, but that's a separate issue. The problem is they don't want to have another bubble build and cause a major recession.
Well, they never want to make the same mistake.
So they're basically like,
twice,
maybe we have to have a mild recession just to get the air out of technology and all the borrowing going on, just to cool things out. So if we let it go another 2 years, it's going to blow up, and then it's going to be just as bad as 08 again.
But your point, the Federal Reserve's creating on purpose another recession that they hope is mild. That's what you're saying.
It's the only rational reason, because again, in real economic things that you think of, and they're supposed to look at unemployment rate, inflation, those things are fine. But the asset thing isn't quite the bubble level we had in 2000 or in 2007. I think they're trying to prevent it from getting that bad this time and not being in this low rate. Unfortunately, because assets become a leveraged bet on the economy now, every time you have to slow down the asset bubble, you have to cause a mild recession. But that's maybe better than a big recession.
I'm just imagining like Edward Lawrence down in 5 minutes to raise his hand and say, Mr. Chairman, is it true you're trying to create a recession here just to see how Jay Powell would handle that?
He's not going to ask that question.
Not a big one by any stretch. Just an itsy bitsy. Yeah, be honest with us. What's your but that could very well. I mean, it's not like it's something, Kimberly, that you would go out and talk about. But if you're weighing kind of the risk of all the different outcomes, and you're on the board of the Federal Reserve, and you say, well, maybe it's not the end of the world if the economy slows down. To Jonas's point, that not necessarily that's the idea, but he thinks that's the rationale, the only one that you can explain. Do you buy into that?
I'm sorry, Colin. I couldn't hear your question.
Oh no, it's all right. So if you didn't hear the whole thing, you're going to miss out on the answer. So I'll go to Hal on it. The idea that if the Federal Reserve, if there were bubbles building everywhere, and the Federal Reserve says to themselves, you know what, we wouldn't mind seeing this economy slow down a little bit, and then for recession as a result of it, you know what, it could be worse. Do you think there's anything to that?
I guess my first question is, where are these asset bubbles that we're talking about? I mean, yeah, we had some tech stocks that were a little high, but where's the big bubbles? It's not in housing.
That's the one he's talking about, I think, is right?
Well, I mean, a handful of tech stocks, I mean, that shouldn't be the focus of what the Fed's trying to do here.
And if you look at leveraged loans in his speech.
Well, the leverage loans have the yield on the leverage loans, or the spread on the leverage loans, has widened out to where it basically is historically now. So I guess you could say there's too much debt in the leverage loan market. I don't know if I'd call that necessarily a bubble, but that's just a way of financing versus doing high yield. But I'm not sure that, I mean, the bubble that I saw in the market, in my opinion, the main bubble seemed to be kind of in things like esoteric things like, artwork, old master paintings and artwork like Andy Warhol's and that kind of thing.
Those are derivatives of the tech bubble. I mean, that's where you get the money, right? Money's coming from the $1 trillion market values in the tech area, and then it's getting spent on art. It's not like the art's the bubble. The art's the follow-on bubble. It's like almost like Bitcoin.
Yeah, I mean,
but
you
Apple
saw in the
in a
existing home
bubble?
sales report this morning that West Coast home sales are really taking it on the
they're already too late. They're trying to get ahead of the bubble, and you can't say that another 20 or 30, 40% in the NASDAQ would have not been a bubble, right?
Make your point, Danielle, about housing. Is that what we're saying?
Well, yes. There's going to be the same way there's going to be knock-on effects that are virtuous and good. There's going to be knock-on effects that are not so good. We saw a ton of weakness this morning in West Coast housing in the residential existing home sales report. That was where we've seen the weakness. San Jose, San Francisco, Los Angeles, home price declines are really accelerating out there, and that is just it's an outgrowth, it's an outcome of so many millions of dollars of wealth being lost on the West Coast.
So just to back this up for a second as we wait for Jay Powell, because we started this all agreeing and now we're kind of arguing about rationale, right? Am I right? Just to be serious, we're not arguing about whether or not the Federal Reserve should have done what they did. It's pretty much you don't necessarily agree with. If you just look at old
school economic numbers, they shouldn't have raised rates. There's nothing there to cause it. The only reason to do it is these issues that they're not really supposed to be focusing on, but maybe which is asset prices, which is psychological benefits to say we're not fighting a recession, that we have tools. There's something there besides inflation, because the inflation is not that bad. It's dropping in other countries. Oil prices are going down. And if it got, what's bad? It would go to 3% for a little while. They're targeting 2 on average. They can make it go away in a month by just burning the money they create. I mean, they would just have to sell the portfolio off.
Right.
The money comes in and then light it on fire.
Right.
It would cause deflation overnight. It's like there's no way it could get out of control like the 70s with their balance sheet.
You think
That's exactly right.
So
I mean,
why-
inflation is so much easier to control than deflation. So there is no problem with having a little bit of inflation here. That deflation should be more the concern.
Right. So do you only think they're doing what they're doing, Hal? In other words, not going with this dovish rate hike that everybody seemed to expect, not having a more dovish outlook. Do you only think it's then because of presidential pressure? You think they're just trying to establish independence then, not to go along with Jonas's rationale?
It's kind of a mystery, actually. I mean, I think that's part of it. I think they also think that they've got to get to some sort of normalized historical, federal funds rate. And I think in their mind, they're like, we've got to get to 3% because that's just kind of what it's always been. And so I think there's that rationale, too. It's really kind of a mystery, actually.
Let me bring Kimberly back in just for a second. She had an audio problem a few minutes ago, so we apologize for that, Kimberly. You missed a great discussion. All the time. But why don't you jump in on this idea of why, not whether or not, we've all had our views on that, but why the Federal Reserve is going down the path it's going and signaling that it's going to keep raising rates, even if it's at a slower pace.
I agree with your other guest. I mean, I think the Fed's absolutely, very myopic in what their goal is, and their goal is normalization by the end of 2019, and that's a 3% rate. That's because, guys, if this economy does grow and does get a little bit out of control, they now have tools in their toolbox so they can.
Got to cut you off again, Kimberly. I apologize. Breaking for the Federal Reserve. Here's the chairman, Jerome Powell.